Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Zhong and welcome to Through the Noise podcast. We are recording this on the 9th of February, which is also the Lunar New Year Eve. Today, every ethnic Chinese family will gather together and have the reunion dinner. Today also marks the start of the long holidays in China. The stock market will also take a break until 19th of February after a disappointing year of the rabbit, despite several attempts by the authorities to bolster the markets. Speaking of which, this week we saw a few more of these supportive measures. To unpack these and more, I've got with me Manpreet Gill, our Chief Investment Officer for Africa, Middle East, and Europe. Hello Manpreet. Let's start with the latest stimulus measures from China's government. Do you think that marks the trough for Chinese equities?
Hi, Jong. Thanks for having me on today. Well, indeed, I think last week we got quite a range of supportive measures from policymakers in China. And these, of course, included a new securities regulator head and more policy purchases of China ETFs. And all of these have really helped to improve investor sentiment and halt the fall in Chinese equities year to date, at least for now. Now, we expect a policy-driven rebound in both China's onshore and offshore equity markets in the near term, led, of course, by the state's purchase of A-shares through the Stock Connect program, and that, of course, coming against the backdrop of depressed valuations and light investor positioning. Now, from a sector perspective, we do believe that China's state-owned enterprises do look increasingly attractive because we've got policymakers' recent focus on improving market capitalization management to, of course, support the sector's equity prices, especially in these uncertain market conditions. Now, that short-term view said, from a longer-term perspective, the one data point we believe is worth monitoring is the risk of prolonged deflationary pressures, because that risks limiting the prospect of medium to long-term upside in the market. Now, if we take China's consumer prices, they fell for the fourth month in January and also marked their steepest decline since the 2008-2009 financial crisis. Producer prices, of course, might have beaten estimates, but they also remain in deflationary territory. So we most probably will need a more forceful stimulus designed to revive domestic demand and enable that positive feedback to consumption. That's most probably what we need to boost demand and sentiment on a more sustainable basis long term.
Okay, so a rebound in the near term, but more is still required in the long run. How about the Asian high yield bonds, right, of which China high yield bonds account for a sizable chunk?
Well, Asian US dollar high yield bonds have actually done reasonably well this year. They're delivering year to date returns of around 3%. And that's meant also that they've outperformed Asia dollar investment grade by a similar amount. Now, what we're seeing from a policy support measure in China is undoubtedly, key driver behind this. Because if you add back Hong Kong and Macau, Chinese high yield bonds account for a little over a quarter of the asset class. And I think what was particularly notable was that we got a rebound in China property sector bonds, despite what's still pretty weak contracted sales in the sector. But of course, it's been a broader rally than that. And we've seen, financials and industrials rebound as well. Now, China, of course, was one driver, but arguably non-China high-yield dollar bonds also had a significant role to play in this performance. Some of that was due to issuer-specific developments, an example of that being successful restructuring in the Indian high-yield bond sector. But I think we've also had much more limited Asia dollar high-yield bond supply. So that's helped to really improve the supply-demand balance for the asset class. So from this point onwards, we still expect Asia high yield bonds to continue to outperform their investment grade counterparts, particularly against the backdrop of the monetary easing we expect later this year. The one risk, of course, we continue to monitor is the risk of weaker economic outlook. And of course, geopolitics and any ratings downgrades or defaults that are a result of that. So those are the risks, but a core view, of course, is outperformance of high yield over IG within Asia dollar.
Let's talk about another Asian market which outperformed this week. MSCI Korea rose 4% week on week. What was the catalyst?
Yeah, I think South Korean equities, have sort of performed as a result of a policy from the South Korean government, the Corporate Value Up program, whose goal is to improve stock market efficiency. And some of this, of course, coming from a benchmark with Japan's equity market, which has, of course, done very well in the last 12 months, despite having some similar characteristics. Um, Now, South Korea's program, of course, aims to encourage companies with a price to book of less than one to help realize their value. And of course, there's the expansion of tax-free benefits on the investor side in terms of the individual savings account. So, those are the combination of measures we've seen announced so far. Now, since we got this announcement, fund flows in equity markets have been positive. Foreign investors have turned net buyers, and we've seen exposure broaden out from the semiconductor industry alone to low price to book sectors such as banks, insurance, and auto, which should be the key beneficiaries of this policy. Now, we believe it's important to remember that this policy is still in the draft stage, and we need to obviously see how this translates into actual corporate actions. And while we've seen recent momentum focusing on boosting low price to book sectors, long-term fundamentals we think will always dominate. So we think from an investor perspective, if you're following a sector strategy, we continue to believe a focus on attractive valuations, high profitability is still equally important. And one great example of this is the auto sector, where we see a high probability of outperforming the broader Korean market because we've got robust sales volume, an improving product mix towards higher value vehicles. And of course, we've got shareholder friendly policies such as share buybacks in 2023, which of course is something that could gather momentum after this new public policy measure. So overall, we just think these measures are fresh tailwind, but we are overweight South Korean equities within Asia ex Japan. So if anything, these measures sort of support that. And just as a reminder, our overweight is driven by expectations that earnings estimates will continue to rebound. But a key driver of that in South Korean equities being improving demand supply in the semiconductor industry. That, of course, coming against a backdrop of Korean equities that are priced at quite a significant valuation discount and arguably less direct exposure to regional geopolitical risk. So that's why recent policy measures great, but it's really just one more tailwind in why we're overweight the market.
Putting it together, what do all these mean from a portfolio perspective, right? Particularly for the Asia ex Japan equity markets.
Well, from a portfolio perspective, we think it's a lot of what we've seen sort of supports our asset allocation views within Asia ex Japan equities. So this week, of course, was really about a revival in investor sentiment, but more of these triggers, of course, coming through policymaker actions in North Asia, in China and Korea, as we discussed, with the goal of reviving investor confidence and eventually with the goal of boosting equity market valuations. So if you step back and say, Asia ex Japan equity markets, as we just mentioned, South Korean equities, that remains our key overweight and a preferred equity market in Asia. And we're of the view that the latest government proposals should help boost valuations on this market. Chinese equities, of course, we continue to view as a core holding within Asian foundation allocations. And we see a more tactical opportunity in the state-owned enterprises sector as both sort of respond to the government's attempts to boost shareholder value. And finally, of course, Indian equities remain a core holding. We've discussed a lot of this in previous weeks, particularly on the positive growth outlook, but coming against a trade-off of more elevated valuations. So in foundation allocations within Asia Japan equities, those are really our views, with South Korean equities, of course, ranking highest.
Thank you for the insightful discussion, Manpreet. I think all in all, the focus for this past week appears to be on Asian markets, be it equities or bonds. The revival in the investor sentiments bodes well for this region in terms of allocation. Just to, I guess, repeat what Manpreet have shared earlier on, China equities remain a core holding in our Asian foundation portfolio. We are overweight on South Korea equity markets, and the latest government proposal to boost valuation that helps to support our preference in South Korea equity markets. And of course, not to forget Indian equities. While there aren't much of a development this week, but it still remains a co-holding for us. And we like and the positive growth outlook is something that we favored and we have discussed about in previous weeks and months. So with that, we'll close off this week's podcast. Thank you so much for listening from start to end. We hope you enjoyed it as much as we did. For those listeners who are celebrating Lunar New Year, have a wonderful reunion with your family. and a prosperous year of the dragon.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.